Hey everyone, welcome back to Corporate Decoder, the place where we decode SEC filings for your profit. And to answer this crucial question, is this company about to buy us all lunch, or are they about to eat our lunch? Today we're diving into OFS Capital Corporation and their latest move to raise some serious cash. They just dropped a report about issuing new notes, which is basically a fancy way of saying they borrowed a bunch of money and want everyone to know the details. It sounds a bit dry, but stick with us because this could signal their future plans and how they plan to manage their money. So OFS Capital Corporation, they've just announced a deal to borrow money by issuing these new notes, which are essentially loans they've entered into what they call a seventh supplemental indenture to an existing agreement. Think of it like adding a new chapter to a contract detailing the specifics of this new borrowing. What kind of notes are we talking about here? They're calling them their 750% notes due 2028. That percentage, 750%, is the interest rate they'll be paying on the money they borrow. So if you lend them money, they promise to pay you back that amount plus this interest every year. The due 2028 part means they have to pay back the main loan amount by the year 2028. And how much money are we talking about here? They're raising a whopping $69 million through these new notes. That's a significant chunk of change. The actual payback date for this loan is July 31 of 2028, so it's a medium-term loan. Now, here's an interesting detail. They can choose to pay back some or all of this money early starting on July 31 of 2026. This gives them flexibility if they find better ways to use their cash or if interest rates change. So why are they borrowing more money now? The report tells us they're planning to use the money they just borrowed to pay back some of their older debt. Specifically, they're going to use the proceeds from these new 750% notes to partially redeem their existing 4.75% unsecured notes that are due in 2026. This is a common strategy when a company believes it can borrow money at a lower cost or simply wants to restructure its debt. And how much did they get from selling these notes? The report says they received about $32 million after all the costs associated with selling these notes, like fees and expenses. This is based on a price of $25 for each note. It's important to note that the $69 million mentioned earlier is the total face value of the notes, and what they actually pocketed is slightly less after those upfront costs. So they're taking the money from the new higher interest notes and using it to pay off some of the older, lower interest notes. This might seem a bit counterintuitive at first glance. However, the key here might be the maturity dates and their overall financial strategy. These new notes mature later in 2028. While the ones they are partially paying off mature in 26. This suggests they are extending their debt maturity and to manage their cash flow more effectively in the shorter term, even if it means paying a slightly higher interest rate for each borrowed dollar. It's also important to understand how these new notes stack up against their other existing debts. The report mentions that these new notes are direct, unsecured obligations of the company. This means they aren't backed by any specific company assets. They rank equally with any other future unsecured debt, but they are lower in priority than any debt that is secured by assets. So if the company were to face serious financial trouble, the lenders of these unsecured notes would only get paid back after lenders with secured debt, like those under their revolving credit facility with Bank of California, are fully satisfied. Furthermore, these notes are also considered structurally subordinated to any debt or obligations of OFS Capital Corporation subsidiaries. This means that the subsidiaries' debts must be paid before any funds can be sent up to the parent company to pay off these notes. So in a challenging economic environment, the value of these notes could be significantly impacted by the financial health of OFS Capital subsidiaries. Now, let's talk about what kind of promises OFS Capital is making with these new notes. The indenture, which is the legal contract for these notes, includes certain covenants. These are basically rules the company has to follow. One key covenant is that they need to comply with specific sections of the Investment Company Act of 1940. This act is designed to protect investors in investment companies. They also have to provide financial information to the notee holders and the trustee, especially if they are no longer required to file reports with the Securities and Exchange Commission. These are important protections for the investors lending money to the company. This whole deal, this borrowing of $69 million and the specific terms of the notes, it all officially went through and was finalized on July 23, 2025. The company has also flagged this move as the creation of a direct financial obligation, which is exactly what issuing these notes is. It's a clear commitment to pay back borrowed money. And finally, for those who really want to dig into the nitty-gritty, OFS Capital has provided the actual legal document, the 7th Supplemental Indenture, as an exhibit. They've also included the form of the actual note itself. So if you're a legal eagle or just curious about contract language, you can find all the details there. Now, looking at this filing, what's the big picture for OFS Capital Corporation? They're actively managing their debt, refinancing older obligations with new ones. The switch from 4.75% to 750% notes, while seemingly more expensive, is likely a strategic move to extend their debt maturity and manage their cash flow better in the short to medium term. They are also signalling a need for capital, possibly to fund operations or growth initiatives. Though the immediate use stated is to refinance existing debt, the fact that these notes are unsecured and structurally subordinated to subsidiary debt does present some risk for new investors, meaning they are lower on the priority list if things go south. However, the inclusion of covenants related to the Investment Company Act of 1940 suggests a commitment to transparency and investor protection, which is a positive sign for a company operating in the financial services sector. So what's our take? OFS Capital is making calculated moves with its debt structure. They're extending their repayment timelines, which can be a good strategy for stability, but investors need to be aware of the increased interest cost and the subordination of these notes. We'll be keeping an eye on how they utilize the freed up capital and whether this refinancing leads to better financial challenge. Right, that's our breakdown of OFS Capital's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.